You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday and welcome to the Macro Sunday podcast, your independent macroeconomic podcast out each and every Sunday all year around. My name is Andreas Steno. I'm the founder and CEO of Steno Research. And in this podcast, we aim at being as actionable as possible towards the end of the show every week, where we will have a discussion on our current portfolio allocations and whether we intend on adding or selling to the current portfolio setup. But as a broad disclaimer before we get going, remember that our trade ideas can be
sometimes maybe good, sometimes maybe shit.
Good old Gennaro Gattuso. Mikkel Rosenvold, welcome to you as well.
Thanks a lot.
Our geopolitical strategist here at Steno Research. And the reason why we have you with us this Sunday, Mikkel, is that it's been a week of turbulence in relation to the geopolitical influence on especially energy markets.
Absolutely.
In roughly 10 minutes' time, we'll invite actually my old boss, Mikael Sarwe, head of equity strategy at Nordea, to discuss the ramifications for inflation and equity markets when the price of oil starts rallying again. But let's set the scene with a discussion on that exact rally in the oil price, Mikkel. You're an avid follower of the OPEC Plus group. What's going on here from the supply side?
Well, it seems like Mohammed bin Salman has gotten a taste of high oil prices up towards $90 a barrel. He really likes that taste, doesn't he? And now he wants more. He wants to keep the price high, maybe even higher. It seems that the new norm of this are voluntary production cuts, as they call it. So these are cuts by Saudi Arabia and Russia. Not entirely unexpected that they would prolong these for the rest of the year. But it is really remarkable that they keep doing this. We'll see how much of the OPEC they can get to follow. But of course, Saudi Arabia sets the tone really for OPEC and the oil market.
Sure, and obviously the mood within OPEC Plus improves when the oil price is as high as it is currently, right? So when you look at the potential sort of moves from the Biden administration, maybe even from Xi Jinping in relation to what we've seen from Saudi Arabia and Russia here, do you expect the Biden administration and the administration in Beijing to do something about this oil price?
Well, I certainly expect Biden to keep on pouring out oil from the Strategic Petroleum Reserve. Absolutely. We've talked about this before in various places, and he's basically the U.S. don't need that in the long term. They don't need a large strategic petroleum reserve anymore, so they're okay with emptying it because basically they are producing so much oil themselves that it's not really a strategic tool anymore. It's more of a market manipulation tool or influencing tool. So I definitely expect Biden to do what he can. There are limits to how much oil he can pump out from the reserve, but he'll definitely do that. With regards to Xi Jinping, my analysis a couple of months ago was that he was slowly gaining more and more influence over the OPEC Plus. But right now, I really don't see how this is in Xi and in China's interests. I mean, they will be struggling with higher oil prices, and it's even though it's the US are struggling with it as well, and it might be a problem for Europe. I really don't see that oil prices nearing $100 a barrel would be good for China. So I'm a little bit mystified about their role in it. Definitely, my analysis on the geopolitical tussle between Biden and Xi is that Biden has, over the past 6 months perhaps, shifted focus a little bit away from the Ukraine war and more into the long-term recruiting of nations that I've talked about here before. And in my opinion, Biden has really put Xi on the back foot on this. Xi obviously turned up at the BRICS summit, put a lot of weight into building BRICS as his infrastructure for geopolitical influence, which has had some success. But Biden has been really active in both. He had the visit from Modi. He went to the G20 meeting. He's been to Vietnam, usual close Chinese ally that they are more or less recruiting to the U.S. side. So the U.S. is currently very active in recruiting nations to the U.S.-led international institutions, and that's going to be the long-term U.S. answer to the power of OPEC and the power of China.
Mikkel, given this trip from Biden to, among other nations, Vietnam, I'd like to play a small soundbite, I think from another trip to Asia, where Joe Biden talked about building railroads, maybe all over the globe. Here it is.
Well, we're going to win and we're going to help. We have plans to build a railroad from the Pacific all the way across the Indian Ocean. We have plans to build in Angola, one of the largest solar plants in the world. I could go on, but I'm not. I'm going off script. I'm going to get in trouble.
A railroad from the Pacific.
He might get in trouble over this.
Across the Indian Ocean, Joe. My, that's impressive. If you thought running railroad track across quicksand was tough,
this was on Australian TV, where obviously they had a lot of fun over this. A railroad across the Pacific to the Indian Ocean. I don't know what kind of world map he's looking at, but so in my opinion, Biden is all but a figurehead now. He shows up at these events, and of course, the most valuable commodity for the U.S. government is the president's calendar and his time. But and we like to play funny clips. This is a funny clip. He makes a lot of gaffes, but I think his administration is doing a stellar job at the moment. They're really getting engaged with a lot of the global South countries. They're investing heavily into the U.S.-led institutions, and that's the long game that will benefit the U.S. and in the long term help alleviate some of these issues.
Mikkel, if we look at the ramifications for the oil market of these developments over the past week, I've had a look at both the supply side and the demand side of that equation. And first of all, it's noteworthy that the daily demand for oil is back above pre-pandemic highs now. And if you asked right about every climate secretary across the globe throughout 2020 and 2021, they basically ruled out that scenario more or less. We're not going to spend as much on oil anymore and blah, blah, blah. And here we are again with a new all-time high in the oil demand. And I personally think it's relatively fair to extrapolate that trend for the next couple of years as well. Even despite the ongoing push towards EVs and stuff like that. And that is essentially why we're now stuck with what I call a supply deficit relative to demand. With demand running at 102.5 million barrels a day in oil, and supply now just south of 100. We're stuck with this, a lack of supply to the extent of a couple of million barrels a day, maybe even 2.5 by the middle of the fourth quarter, if I'm right, that the manufacturing sector and all that will pick up activity. So how important is a deficit of, say, 2 to 2.5 million barrels a day? It's frankly something that we haven't seen in decades. We had a small observation towards the same kind of supply deficit through 2021, but it was a short-lived one. While we need to go back to the early 70s, the early 80s to find similar supply deficits in the oil market. Obviously, I do not account for the release of the Strategic Petroleum Reserve in this calculation. So if Joe Biden releases, say, 1 million a day, then we're stuck with, say, 1 to 1.5 million.
But there are limits to how much he can release from that.
First of all, yes. And should he decide to release 2 to 2.5 million barrels a day, which is technically tricky, by the way, they will basically run out of reserves by, say, mid Q1 next year. We're currently at a bit more than 300 million barrels in the SPR, and if they release 2 a day, obviously you get there in 150 days or so.
And that's way too early when you think about the US election coming up.
Exactly. So they probably want to save some of the ammunition until the second half of next year, right? So I'm pretty certain that we will get a supply deficit through the fourth quarter in oil markets. And we've had a look at the empirical evidence, and it seems like a 2 to 2.5 million barrel deficit a day equates to roughly 30% higher oil prices over the course of a quarter from here.
That's a lot.
So, 125 or thereabout in the oil price.
And that's not counting in any new hurricanes in the coming hurricane season that really could affect the U.S. own oil production. What's really interesting in the long term here is that we're seeing the Saudis also investing in new oil production. Even though they're cutting production, they're also investing in their long-term ability to produce. So right now, they're leaving a lot of oil in the ground, but they're investing in their ability to pull up more oil in the future. And of course, that comes from higher prices. But could other parties be interested in that as well? If the oil prices go above 100, will we here in Denmark, Norway, begin pumping oil out of the North Sea, other countries?
Yeah.
That's an interesting part, and could be investments in other energy sources. A lot of these things get into play when the oil price gets close to $100 per barrel, which we could see.
But I can guarantee you, 3-4 years back, a price of $100 a barrel would have led to a remarked increase in the rigs count in the US. Right now, no developments in that direction because they're not allowed to, more or less, at least. The Biden administration has essentially ended that dream. And you could, of course, argue that there are good reasons to do so. But right now, we're painting ourselves into a corner, so to speak, from an oil market perspective. And Mikkel, the interesting thing here is whether an oil price spike leads to a second wave of inflation and ramifications for central banks, equities, and everything in between. And I think the guest of the week is one of the absolute best allocators and strategists within the equity space in Europe. So let's introduce Mikael Sarwe to the Macro Sunday and discuss whether this inflation spike will be bad news for markets.
And of course, with the Swede in there, we had to play a little.
Strategy in Nordea. Mikkel, it's great to see you.
Yeah, you too.
Mikkel, I think it was this week or last week you wrote an analysis called "The Plot Thickens," sort of referring to the recession or the lack thereof, and a potential thickening of the plot when it comes to the GDP numbers versus the GDI numbers. So please elaborate why this plot is thickening around the US recession.
Yes, of course. I'll try to at least. Now, I've noted here recently that my leading GDP models for the US that historically has been extremely accurate and basically been correct each and every time. Right now, there's a huge divergence with what the GDP numbers are showing and what the model is saying that they should be showing, giving a lot of underlying data. And GDP in the US is increasing 2.5% year over year. But then I noted that if you think sort of more about your old national economics classes, you would perhaps remember that there's another measure which is called GDI, or gross domestic income. And in theory, gross domestic income and gross domestic product should be exactly the same number. In practice, they get the numbers from different sources, so they aren't the same number. And the funny thing right now is that GDP is showing 2.5% year-over-year increase, while the GDI is showing a minus 0.5% year-on-year increase. According to GDI, which should be the same number as GDP, the US is actually in recession. Now, which one of these numbers that actually are correct, nobody knows. Of course, we in markets and economists tend to look at GDP because then you can get also what the demand components are basically. So very few look at this GDI number. But if we look back into the past, it is a little bit interesting because, for instance, the financial crisis, we saw exactly the same development, that the GDI numbers dropped. And then after a number of quarters, GDP got revised down. And of course, GDP also entered a recession. So it was very much a leading indicator back then.
So, Mikkel, given these circumstances around the differences on current developments in the GDP versus the GDI and large revisions with large time lags, when do we actually know whether we are in a recession or not?
Probably when we're old. I'm already old. You're not. No, but it could take quite a while actually. But I think if we are to sort of take it down more into the markets and where market participants might think about it, then it will be when there is a clear sign that unemployment starts increasing, I would say. And of course we haven't seen that yet. It's a little bit different if you look at the non-farm payroll figures or the unemployment figures, because unemployment looks like it at least is bottoming, while the non-farm payroll figures still are increasing. So unemployment will clearly be the important factor here. And looking at that, I think there's been a quite large amount of more leading indicators recently that are going the wrong direction, such as I mean, job openings falling quite dramatically. You had a new cyclical high for layoffs in the U.S. Presented last week. We can see in the consumer confidence survey, which I think is important, that the more short-term indications of what households are seeing on the labor market has deteriorated. Temp jobs are falling, and so on. So to me, it should be a story we should be aware of, that it's a recession by late 2023, I would guess.
We currently have this weird discrepancy between the ISM services and the ISM manufacturing. So the two major gauges of economic activity in the US, services doing much better than manufacturing. But if we look at some of the usual leading indicators for manufacturing, for example, orders to inventories, it actually looks like manufacturing will rebound from here. So what do you make of this odd cocktail of, say, a weaker labor market ahead, but potentially stronger manufacturing? Is this something you buy into?
Well, I agree with you that if you look at the kind of order versus inventories numbers and other leading indicators, you can look at kind of the forward data in Philly Fed, for instance, or whatever. They are clearly looking less bad, let's say it like that, at this point than they were a couple of months ago. So there are some fish hooks going on there, and we will see what happens there, because of course it could be lagging effects of the old China reopening story in the sense, and we'll see what happens there now if that turns down again. But otherwise, yes, clearly so. And the services PMI, I would claim that it's normally more a lagging indicator than anything. Usually the services PMI follows what retail sales and some other domestic data was doing 1, 2, 3 months ago, in a sense. So in that sense, the manufacturing data tends to be more important. I mean, some of the data has bounced quite a bit. Other ones, it's just a sort of off lows and very low lows. And in some sense, the activity has never been down there to start with. We haven't really reached that yet. So it is a tricky story, that one. Of course, for the US, over time, the most important point will be if the labor market weakens, because then since personal consumption is 70% of GDP, that will sort of decide the day and not the manufacturing cycle.
Miki, if you look across your leading indicators, both for the US, Europe, and Asia, how do you sort of gauge the momentum across various geographies right now? Is the US still sort of the cleanest shirt in the dirty laundry here?
Yeah, and I mean, I think I would say the other regions have more moved in line with my expectations if we go back a year. And take Europe as an example. We had, of course, the Ukraine war, the energy problems, which pushed down sentiment, and they bounced when those things eased. But now things are turning down again, clearly, and quite quickly. So you have the IFO dropping, you have some leading labor market data now actually starting to look more negative. And it follows the normal pattern when you have a massive monetary tightening. It takes a lot longer than you would guess. I mean, I'm in Sweden. Here in Sweden, we have a lot of variable rate loans. So here the effect is pretty quick. And in Sweden, we are in a recession clearly already now. Germany is in a recession as well. But if you look at the monetary gauges, they're basically saying that the worst time for the economy should be around the middle of next year, not the middle of this year. which is true both for Europe and in some sense also for the US. If we talk about the sort of domestic effects on consumption and so on, so that is moving along as expected. And China, I mean, I never really bought into the reopening, this enormous story, and now things are turning the wrong way again. The authorities, of course, are doing what they can to try to turn it around. I think it's difficult. The domestic indicators look really bad, but we'll see. Given that the Bank of China seems to be adding a lot of short-term liquidity into the market now, it could still be that they find some sort of cushion below the equity market there. But I have a hard time seeing that China will sort of jump out of this negative trend very quickly. Looks also there, I have to admit, though, a little bit better on the manufacturing side, which kind of lines in what you were saying on ISM and orders minus inventories. But the domestic economy seems to be heading totally the wrong way.
Miki, if we look at the central bank outlook amidst this uncertainty in services, labor markets, etc., it seems like across the G10 space that markets have sort of sniffed out that we're very, very close to some kind of coordinated pause. At least we're close to peak in forward pricing of right about every big central bank. Do you buy that scenario, or do they have more job to do?
I mean, I think we're getting fairly close to the peak, clearly, and it could. I mean, in the US, we could have passed the peak, but I do think a couple of things that are annoying me right now. The first thing is that in Europe and for the ECB, even though now it seems like a 50-50 call if they will do anything here this month, I would say that the inflation indicators, if you look at kind of core CPI, 3-month rates, and where you have wage growth and wage indicators, they basically say that they ought to hike more than the market is discounting right now, given that they are an inflation tracking central bank. So I would suspect that we will get at least one more hike from the ECB, probably two in my mind. The US, of course, have hiked more and is further along in this hiking cycle, and has an interest rate that is restrictive, which also Powell has alluded to. But what I'm a little bit worried about there is that now we've had a fairly benign development over the recent 3-4 months in terms of inflation coming down. But my kind of headline models have started to, and you know that one, you've seen it as well many times, it has started to move sideways. So the CPI is just above 3% year over year in the US. My model is basically telling me that it will remain there the early parts of 2024. So you will not have that huge help from inflation coming down anymore. I think that will be problematic for the Fed, unless there's quickly a bad recession, of course. And then there are some other indications you can see in other price indications that pricing plans, both within the ISM and other places, have started to or stopped falling and starting to turn a little bit up, which I guess is partly, and probably it could be that wage growth still remains too high. So there still is a need to push through cost increases to the consumers. And then thirdly, which is something that we will see what happens with, but we of course have the rent component of inflation that made you and me actually pinpoint correctly that inflation would be much higher than people expected a long time ago now, and that one is set to slow in the CPI terms for a while now, clearly, because it's a lagging indicator of what's going on the actual rent market. However, if you dig a little bit deeper in that, you can see that landlords are once again demanding quite huge rent increases into 2024, which is even a further leading indicator than the actual market rents are right now. So there is a scenario where the Fed is now saying that we don't have to care about rent inflation because it's going to come down. But there is a scenario when these more market-based indicators turn up again next year. So the inflation story is getting more complex, which means, I guess, firstly, that it will take a lot longer before we see any rate cuts than otherwise would have been the case. But it could also mean that we haven't seen the final rate hike by the Fed.
Interesting times, and also given what happens in energy right now, the risk is obviously on the upside to US headline inflation. In relation to this discussion on shelter, it's worth noting that the HICP methodology in Europe basically does not discount shelter to any large extent relative to the US. So we can largely ignore that component for euro inflation at least. But if you look at the shelter component and the ramifications of high interest rates, to me it seems like sorry, that landlords, they basically need to push up their rents as a consequence of central banks having a tight policy. So is there a negative feedback loop here, Mikkel?
The problem is, I mean, I'm a Swede, so here we have rents that don't move, so it doesn't matter here. But down in Europe, yes, there could clearly be such a negative feedback loop, and of course, inflation as such is one reason why the real economy is looking weak to start with, and as long as central banks continue to push up rates, clearly capital costs will increase and everything like that. So there should be sort of a second round of more, let's call them capital cost related inflation, which might be part of what we're seeing in the US with landlords demanding more rent, and also now seeing in more in Europe, and of course that takes a little bit longer for it to come through. Which could also sort of align with this story that, the 70s, where the central banks think they made the mistake of cutting rates too soon, and then you had the second wave of inflation, and all of this research that points to once you've had a huge inflation increase, then it's much harder to get it down again. So all of that ties into it. That said, I mean, I still find that the big problem with the central banks have been that they pushed down real rates too much for the past 10 years. I mean, they're not excessively high now. If you look in the US, if you take sort of the 10-year yield minus sort of the long-term inflation expectation of professional forecasters, we're basically back to where real economic growth is over time, potential GDP growth. That is not an excessively high interest rate if you look into the past. The problem, however, is that people have gotten used to very negative real rates, and then things will at some point hurt them.
Mikkel, amidst this discussion on inflation, how do we look at equity markets? I know you look at equity markets day in and day out now. Anything you like, anything you dislike in equity space?
I mean, the equity market has been quite odd this year. I have to admit, I would have expected it to be much weaker than it has been, and which I guess comes back to the US economy keeping things together better than I expected. That said, I mean, if you sort of pop the hood a little bit and look underneath what's going on, it's been a very narrow equity rally this year, particularly driven by some AI names and the tech side. So it on the surface it looks much stronger, the equity market, than it actually is. I mean, if we look at the Nordic indices, or the Nordic index for equities, total return, from early December last year, it's actually down, which is perhaps surprising for many. Same is basically true if you look at various types of equally weighted indexes where each company has the same weight. Those indices are basically flat. So it's been a very, very one-sided equity market in that sense. And then the second point is, if you look globally, and this is kind of what we have been advocating our clients to own. What has really outperformed is apart from that, is quality companies. And what are quality companies? Well, those are companies that have shown over time that they have a higher stability on earnings, basically. And also higher stability on return on capital employed, and those companies are outperforming the way they usually do when we're entering a recession. So my suggestion would continuously be to focus on those type of companies, to be along the quality bucket. And I still believe, as you guessed, that in my scenario there will be a recession, and if there is a recession, then the equity risk premium is way too low to swallow that one, I think. So I still see that we will see quite a bit of further downside on the equity market between now and the middle of next year.
So if we look across the asset landscape in relation to this recession, let's assume that it arrives next year. Is it priced into bonds, FX, equities? Where do you see the biggest discrepancies relative to this recession outlook?
Well, I would the biggest discrepancy is clearly equities, followed by corporate bonds, I would say. Yeah, I mean, if you look at equities and calculate the risk premium, i.e., what you get paid above the risk-free rate, basically, it's down for the S&P now to about 1 percentage point. Normally, it's between 3 and 4 if you look over 100 years' time on average. So it's a very low risk premium to start with. And if we look back at previous recession, it's just usually jumped, at least in after the financial crisis, it's jumped to maybe 5 or 6. So it looks very expensive, even if there's a good scenario. And you can, of course, toy around with those numbers. You can compare it with the corporate bond market. The earnings yield of the S&P is almost 1 percentage point lower than you can get on an investment grade 10-year bond in the US. Normally, it should be like 2 percentage points higher. It would demand much more compensation for risk on the equity market. And on top of that, of course, the investment grade bonds are trading basically at par with the short end. So you could basically put your money in T-bills and your expected earnings yield on the US is lower than that. So it isn't really that you're ex ante, you're definitely not getting paid to take on company risk. Then you can get away with it anyway. If there isn't a recession, then time will take care of it. But the starting point is that why not put your money at 5% in T-bills when you have an earnings yield that is lower than that in the equity market?
That's an absolutely fair point and a great observation, Mikkel. It was a pleasure hosting you here at the Macro Sunday podcast. Thank you very much for being with us, Mikael Sarwe. Back from the interview with the dancing queen, Mikael Sarwe. I actually think, Mikkel, that Michael really hates ABBA, so he will not fancy your choice of music here. By the way, Michael is also a DJ. He doesn't look like a DJ, but he is a DJ. And if you travel to Stockholm, he's readily available at various nightclubs week in and week out, during the weekends at least. So that was the funny information of the week about the guests, I think. Mikkel, the discussion with Michael obviously centered around this inflation narrative and whether there is a risk of a second wave also in the price of shelter, so the housing costs, given everything that we see in energy prices and related price developments at the moment. From a geopolitical standpoint, first of all, the talk of this second wave of inflation, it's been ongoing over the past weeks with this price spike in oil. Do you see any sort of similarities, anything that reminds you of that double top inflation wave that we had in the 70s and 80s from a geopolitical perspective?
Absolutely, the oil is the key ingredient in both situations, and the shock of higher oil prices. It's not the same shock as in the 70s. Back then, we had no idea that oil could be weaponized and have that effect on the economy. We all know that by now. But over the past decades, I would say almost, we've become accustomed to a steadying of oil prices, I would say. It's been less of a geopolitical issues, mainly because the US have ramped up their own production and Canada has. But it's really back there. It has a huge influence. And inflation equates in political terms to cost of living crisis, which we're seeing in a lot of countries, especially in the UK. So this is going to be a huge situation. I imagine this is on the top of the agenda in any European government at the moment. Still, no one has really have good answers. The strategy all over Europe has basically been to more or less to try and leave it to the central banks to solve this with varying degrees of luck. But at some point, we will begin to have elections. With elections, we will begin to have politicians who claim that they can solve the cost of living crisis by pouring money out of the state's wallets. So that is generally what I'm looking for. This has been an election light year with few elections. That's what I mean. But next year we're going to have a lot of elections, and it's going to play into them in a big way.
So we'll get a European Inflation Reduction Act.
We could have, yeah.
Probably the worst name for a piece of legislation I've ever seen. I mean,
it's a great name, although the abbreviation are raised. Absolutely fake news. It's the complete opposite as far as I can see.
Yeah, more or less.
So
at least you could argue that.
Yeah.
Mikkel, a few observations from my side in relation to this second wave of inflation. Given what I described in relation to oil markets earlier, oil could easily rally to plus 100, maybe even as far as 125, I think. And unusual studies and correlations, that is enough to lead U.S. headline inflation to the range of 4 to 4.5%. I mean, nowhere near palatable levels to Jay Powell and his ilk. This week, we'll get to, on my models, 3.75 or thereabout in U.S. inflation again. Remember that we were below 3 just a couple of months ago. So I get the idea that people find it likely that central banks want to pause because they've frankly been, if not highlighting it, then at least warming up for such a scenario for a while. But cuts, given that inflation is running a couple of percentage points above target, forget about it. I mean, and we have, I think, 4 cuts in total roughly priced into the Fed funds curve for next year. I struggle to see it right now. I simply have to admit that we at least need a very, very dire recession to get there. Obviously, you cannot rule that out, but inflation on a forward-looking basis is closer to 4 than 2 in 6 to 12 months' time, if you ask me. On top of that, you have the notion, the idea that politicians can actually solve the cost of living crisis via fiscal intervention. And yes, I think they can if they did the opposite of what they're doing. So take the example of the Inflation Reduction Act paired with the Chips and Science Act in the US. We've made a tremendous chart and a tremendous study on this on our research platform, showcasing how the construction activity in everything related to manufacturing of semis, manufacturing of batteries, some of these very strategic areas of concern for the Biden administration, that construction financing for those particular manufacturing sectors has skyrocketed since the legislation was implemented late last year. If we look at the projections from the Congressional Budget Office, they project an addition roughly of 500 billion, I think, to the aggregate deficit over the next decade as a consequence of these pieces of legislation. On most recent trends, they will be wrong with a factor of 10, 15, or 20, I think. I mean, they have no control of the size of the bill right now, over the size of the bill. And it's quite frankly scary. But I mean, obviously, it's actual activity, but they get tax credits, meaning that the tax income will drop in the US as a consequence of this. I wouldn't rule out that we see 5% 10-year interest rates in the US on a cocktail of no control over the fiscal side paired with inflation running too hot. That's what I'm saying.
Which would be really harsh for the US housing market as well.
Yeah.
That could be one of the next dominoes.
It could.
Absolutely. I heard the notion of immaculate disinflation. I guess that's been put to death. We fast forwarded to the crucifixion of that disinflation, or what?
I'm still much more upbeat. Is probably overdoing it, but more upbeat on the prospects of Europe bringing inflation back to target. But still, even in Europe, we have some of these ongoing developments, both in terms of wage formation, but also potential legislation to counter everything that the Inflation Reduction Act is about in the US. I mean, why don't we? I think it's pretty feasible to expect something on European soil emulating that, basically. Then we got the news over the course of the week that IG Metall, the metal union in Germany, asks for a 4-day working week plus 8.5% wage growth for a part of their member base in the northwestern part along the Ruhr district and north of that. I mean, even though I'm generally in favor of working less, I'm not sure the timing is optimal to introduce a 4-day working week in Germany, given that the industrial complex is basically underwater.
No, exactly. If you have to decide where to put an auto factory, you're not going to put it where people only work 4 days a week. And they have to be really, really, really productive and effective for that to work when the wages are that high. So that's a risky gamble, although I understand the desire, of course.
Yeah. So, Mikkel, summing it all up in our portfolio update here, we're long energy, we're long 2-10 steepness in the dollar curve, we're short consumer staples because of those wage demands. Then we're short the euro versus the Korean won. We're short the sterling versus the dollar. And someone got annoyed at me last week saying that, well, you cannot just reiterate a portfolio. That's not actionable. And it is, because I still want to buy them as of today.
Yeah.
If I could start with a blank sheet, I would buy them again.
Yeah.
So I think that's actionable.
Yeah. And if you already have these, you can keep them. I mean, I know that's not an action, but I think it's a bit of a stretch to call
it's
that.
It's also an action not to do something.
Exactly.
Yeah.
I mean, yeah.
Let's leave it at that for this week, Mikkel, and let's conclude with a clip or a soundbite from Trevor Noah, host of The Daily Show, on inflation and that risk of the second wave. Let's listen to Trevor here.
Again, inflation numbers are out and prices are still going up, affecting everything from gas to Halloween candy. And not only that, razor blades are up 52%. Now what am I supposed to put in the candy? Oh, how do I live? I will say a 34% increase in candy, that is a lot. It's so expensive, parents are going to start encouraging their kids to get into strange vans, you know? Just like, look, Timmy, the stranger says he's got free candy, and in this economy, we got to take a shot, buddy. We got to do it. You got an air tag. I'll find you. People, all this inflation is just not sustainable, right? Because here's the thing. Inflation is a lot like masturbation, right? Yeah, a little bit is completely natural. But once you start noticing it in restaurants and car dealerships, things are gotten out of hand.
Good stuff.
Inflation is like masturbation. Is that the title of a show this week?
It could be. Was it last week or the week prior to that? I labeled myself an ex-banker, but still a wanker. So. Mikkel, always great seeing you.
Likewise.
And I guess the final thing that we ought to remind people of is that if you want more of all of this, if you want access to the live portfolio, if you want the trade alerts in your inbox, if you want access to the 15 to 20 pieces of thorough research across sectors and geographies every week, go to stenoresearch.com and use macro30 to get 30% off your subscription. And we'll leave both the coupon code and the link to the subscription landing page in the show notes. With that said, I wish you a great Sunday and a great remainder of the weekend. And Mikkel, we'll see you again next week.
Thanks a lot. Bye.